So delighted to be joined on stage by our representative from Colombia, Threadneedle. In fact, Ingrid is their head of portfolio management and financing within the infrastructure investments team. Previously, she was also responsible for managing global infrastructure portfolios, including the European Sustainable Infrastructure Strategy. Ingrid, a big welcome to you. Thank you for joining us. And seated on your left-hand side, we've got Sebastien Roca, who is the managing director of Cedrus Partners, an investment firm based in Paris, Madrid, and Luxembourg. For over 15 years, he's worked mainly with large families and associations, building robust and resilient portfolios over the long term. A big welcome to you as well. Stéphane, over to you.
Thanks a lot, Jim. So welcome, Ingrid and Sebastien. Good to have you here in Luxembourg. So could you just quickly summarize for us what you do within your firm and also what your specialty is?
Sure. So I work in the infrastructure investments team. Together with a couple of colleagues, we set this up about 5 years ago. Colombia Threadneedle is a very large multi-manager. We've got nearly $1 trillion assets under management, most of which is public markets. So CTI had a real estate business as far as private markets was concerned, and 5 years ago, they decided to go further into infrastructure to offer that to clients, and that's when we set the European Sustainable Infrastructure Fund.
Hello everyone, so I'm Sebastien Roca, the managing partner of Cedrus Partners. We are an investment firm based in Paris, Madrid and Luxembourg, and we build a robust and resilient portfolio for long-term investors, so it's mainly family offices and endowments and foundations. In numerous, we advise around 10 billion euros. We have more than 35 employees, and we do that for nearly 15 years.
So you're both investment groups with more liquid or balanced strategies, and now very interested by private capital. When did that happen? And where does that interest come from? You want to start, Sebastien, and then we can...
Okay, I start. Our interest in private markets came for a decade. Actually, we had a foundation who wanted to get more tangible assets in their portfolio and also to get more predictable cash flows. So we work with them with the infrastructure, so the same asset class than Ingrid. And also we work for large families, and in family they have more the private assets in their portfolio. So we had to beef up our expertise to help them to deploy the investment program.
From our side as well, I think there's been increasing demand from our investors, which are the private capital products have been mainly targeted at institutional clients rather than retail. And there's been an increasing demand to invest in infrastructure as a source of potentially more stable cash flows, long-term cash flows, yield, less volatility and diversification from the general public markets. So as a result of that, so Colombia Threadneedle did that through their real estate products. So they have probably around 35 billion under management in real estate. And it was seen that infrastructure is really the missing piece into the real assets world. So now we've set this up. It took probably about 1.5 to 2 years to really set up the product, the setup, the back office, and all of these things we'll probably touch on a bit later. But really, it was to address investor demand and existing client demand to have an additional product in the repertoire.
And in this context, could you, let's say, describe a little bit more the initial trigger of launching that idea? So how did you do it?
So for CTI, it was an organic. They looked at various options, acquisitions and organic. I think at the end they decided to hire a team, which is the team that I was part of. So together with another 3 colleagues, we got on board and really started building up the fund offering. So it took some time to really set out the strategy. We decided to focus on core infrastructure, which is really the sort of niche that we saw in terms of a consistently yield-paying kind of product that would complement some of the other products that CTI offered. We took the view that infrastructure is a long-term asset class. We actually set up an open-ended strategy as opposed to closed-ended, which is more similar to private equity. The trigger was really, we worked with a couple of clients, sort of some strategic clients of the firm that had interest, also with some other potential clients, who were like pension funds, insurance companies who had expressed an interest. So we structured this, the strategy in a way that was appealing to investors who are looking for this sort of long-term investment, for yield, for stability of returns. We also focused the strategy in the mid-market, which again, it was something that was interesting, and we see a lot of opportunity there. So you have the sort of the mega funds, which are sort of multi-billion, and they focus on the very large transactions. And we saw a gap to some extent in the mid-market space to provide sort of equity tickets in the region, anything from 20, 30 million to 100 million. And that for us was a good hunting ground for this kind of investments, which can offer potential growth, but also stability, the stability of the infrastructure class, the usual characteristics.
And on your side, Sebastien, so the initial trigger, and then afterwards, how did you do that? I mean, did you hire or build an entire team? The expertise, the track record, where did those come from? And if you want to complement Ingrid later on with more details, no problem.
Does it work now? Yeah. So
yes.
the initial trigger was our client wanted to diversify their portfolio, actually, seeking higher yields in low or even negative interest rate environment. And also they wanted to invest beyond the public market, which were pretty volatile at this moment. And last but not least, they need impact on their portfolio. They wanted to understand the real economy and also the story of the entrepreneur they finance. So that was the trigger. And how we did it, so we built a team of 6 people, which is the investment team of Cedrus Partners, comprising among managers, analysts, who cover all the asset classes of private assets. So it's not only private equity, but it's also infrastructure, private debt, and real estate. This team allow us to commit for 2023 400 million euros on the private assets. So we are an LP pretty active for the moment. And also we had at this team a team of data scientists to analyze what's it's inside the portfolio, to do a transparency of all the portfolio of private equity, to monitor also all the capital calls and to know the cash at work you will have, because we think there is two things to get a good portfolio. You have to find the good GPs, so that's why we have the investment team, but you have to know how to assemble it, and that's why we invest in the data and also in the investment team.
And to rebound on that, what were the operational changes within your teams, your structures, just shortly touched on, and a little bit any challenges you, let's say, saw on your journey?
That's an interesting one. There are plenty of challenges to set up a completely different business within a public markets asset manager. I think what was really helpful is to identify some of these kind of challenges and risks very early in the process and hire appropriately. So I think back office is a key thing. So it's they've hired, so CTI have hired, apart from the investment team, which is initially 4 investment professionals plus a couple of analysts. They also hired dedicated resource for the fund operations. So it's sort of middle office. We actually use an external fund administrator, but internally you still have to have the right fund accounting resource and a good team to manage sort of capital calls, reporting, all of this kind of stuff, which is an ever-increasing list of requirements from investors. The other thing is marketing and sales. So in order to fundraise, obviously you sell differently a private markets fund than you do a sort of global equities fund. So I think, again, it was a bit of a learning curve. And the company had to invest quite a lot of resource into making that happen. Finally, something that works really well, actually, and other maybe independent asset managers wouldn't necessarily get was the broader platform. So for sustainability, we are running a sustainable strategy. So it's actually been extremely helpful to have a team of sort of 30 people doing responsible investments at a broader level and looking at the public sectors. Ultimately, whilst we operate in private markets, the sectors, the industries are the same. So you can learn a lot from best practice in public markets to apply in private markets where you have a lot more control. You sit on the board, you can influence, but there are a lot of lessons to be learned and shared with the other teams. So that was one of the elements, getting somebody to sit with us from the public markets team in terms of sustainability input was really helpful. And also on a broader level, it's the sort of sector and macro research. So as an asset manager, we are very driven by research, and again, extending that into the private markets, we probably got that extra little bit of resource and input from the broader team to help us with our strategy. And again, that was very helpful in what is a very competitive and very fast-moving market, to be able to identify trends, see where our colleagues in the public markets also look in terms of infrastructure, energy transition, all these kind of things. It was really helpful. So we set up a really broad team, hired people to be able to cope with all of these additional requirements.
And what about Cedrus?
At Cedrus, actually, as I told before, this year we will commit around 400 million euro on the private assets. So we changed a bit to be more known about the GPs, because half of the money we invest, it's in the US and half in Europe. So we have to get more visible, to do a lot of travel, to get calls with all the GPs. We did also, for example, as we work, we think we need to use all the tools, as I said before. So when we invest, we don't want to invest only in private equity, and we want to have a diversified approach. And for example, there is a statistic I like to talk with my clients. It's not from me, it's from a partners group. They said that when you invest in one GP, in one vintage, the value at risk, so the downside risk, is around minus 25%, and your volatility is around 13%. And when you have a diversified approach with private equity, infrastructure, private debt, and real estate, and with different vintages, the value at risk is almost zero, minus 1, and the volatility is 4%. And this is exactly the way we would like to work with our clients. We don't want to be the best performer, but we want to have a lower risk and get the access return with this risk.
And since you can choose, let's say, kind of best of two worlds, based also on your different client types, what would be, in your eyes, the best diversified strategy you could propose? The things I think with the liquid and illiquid don't have to be exclusive. We think that to build a robust and resilient portfolio, we need to use both of them. The thing is, the traditional portfolio, 40% equity, 60% fixed income, traditional portfolio doesn't work as much, so that's why we think it's better to introduce private equity. But to introduce private equity, you have to get a liability, so you have time around you, and also when you have time and you can have a higher risk, it's important to get more private equity or private asset in the portfolio. That's why also the families normally have a percentage of private equity around 20 to 40% compared to other kind of investors, like institutionals, normally it's around more 10%.
And from our perspective, I mean, obviously as a manager and having one fund, we decided to structure it in the way we did, which is an open-ended structure, especially to help mitigate some of these issues with vintage of sort of single fund issues. So in an open-ended fund, whilst you raise capital continuously, but the advantage of that is that you keep investing. So a closed-ended fund in infrastructure or private equity will typically have a fixed investment period, so let's say 2-3 years. And even if the duration of the fund, that we've seen that increasing over time from 5 to 7 to 10, now to 12, and even you have closed-ended funds up to 30 years, you don't have that additional equity that keeps coming in. So effectively, what you've invested in day one, the first 3 years, will stay with you for the 30 years. In an open-ended context, that's exactly how we see that as a way of diversifying a portfolio over time, is to keep adding assets to it and rebalancing with the assets that we had. you can also start looking at macroeconomic diversification, because each individual asset will be fairly correlated to interest rates, to GDP rates, to inflation. But the idea is to put together a portfolio which combined will have a stable performance. So again, to your point, we're not looking to achieve 20% returns, we're targeting 8-9% returns. On a net basis, we're targeting a sort of 5-6% yield, which in the current market doesn't seem like a lot, but if you take a view through the cycle and if you take a long-term view, delivering that consistently has a lot of value potentially in the context of an investor's portfolio construction. So we diversify as much as we can within the portfolio in that way, sort of looking at macro diversification and over time, and hopefully fit into a defensive part of a portfolio for a client.
Very good. As an industry, we all closely follow the evolution of potentially attracting new investors to our favorite strategies and markets. Is that also a trend you're following and also will implement, if not done yet?
Yeah, absolutely. We started with institutional investors, but we've seen more and more interest from not quite the retail end, because I think I think it's an asset class. There's still some education to be done in that space, even though we have the LTIF structures and so on that we keep an eye on. But we've seen a lot more interest coming from family offices, from the wholesale market, from private banks, so high net worth individuals. So I think it's as close as you get to professional investors, effectively. And some of those categories have been invested in real estate and private equity, so they understand a little bit the structures, the liquidity, because obviously liquidity is a big consideration. And they seem to be ready to go into infrastructure, which is probably a longer-term part of their portfolio. I think if you have a 5-year investment horizon, you probably shouldn't invest in infrastructure. If you can take a 10, 15, 20-year, then it's probably more appropriate. Foundations as well, because there you have this issue of generating sufficient income on an ongoing basis, but ultimately having the capital growth over time to support the operation. So again, we see new types of investors coming into the mix.
And on your side?
And we have a vision that the private investors will increase their percentage of private assets. In 2019, we launched our Fund of Fund program, mainly in France. So it was a beginning. We are a pioneer to democratize the asset class to the private investors. And now we start working also in Luxembourg. That's why we launched the office in Luxembourg 2 years ago. But we think that the private investor in Europe, they have maybe less than 5% of private equity in the portfolio. But when you go to the US, it's around 15%. So we have a huge market in front of us. But we have to explain and to do a lot of pedagogy of this strategy because they didn't know that before. So that's the way we work at Cedrus and the vision we have for the next years.
Just a quick last out-of-the-box question. Are we currently witnessing a convergence of the liquid and illiquid space? Is that something which, let's say, you find interesting from your firm's perspective?
From liquid to illiquid?
Yes, the convergence. I mean, sometimes you heard, the UCITS directive coming closer to the AFMD. Is that something which is, let's say, some wishful or not really? Or would you like to keep it more separate?
I think we should construct the portfolio with both of them. You can see in the market, every day you see a big firm who's launching his Evergreen program. So they are all looking at this thing. What is interesting on Evergreen is like you have a part of liquid, and also all the interests are going to be invested inside. So the compounding effect is good also for the performance. So we think that depend of the client and the profile of the investor, but the rate today is 4 to 5%. And when you build an investment program in private assets, you will get your money called in several years. So it's interesting to match with also some cash, which is well remunerated for the moment. So you will have a better IRR with that.
I think from my perspective and sitting in the investment team, I think the broader the investor universe, the better. At the same time, I think we need to be careful not to create artificial constraints on the investment strategy. So ultimately, from my job is to deliver returns according to the strategy that I sort of put in front of investors. I think once you start, infrastructure is not a particularly liquid asset class. Yes, you can sell assets and there is interest, but it shouldn't be driven by that's the whole point of it, to be a little bit decorrelated from the general supply demand in the market. So I think that's the only bit that I would actually be quite careful when we get fund structures and what we're doing to make sure we stay true to the strategy as opposed to sort of trying to create artificial liquidity in an asset class which is not naturally liquid. And the education is a big element of that, to make sure that investors who come into it are prepared for a long-term hold rather than sort of the markets go down and they want their money back, because it doesn't work like that.
In any case, we expect that those going hard on democratization in the future will be those able to cope with those two worlds on an operational but also asset management selection side.
Yeah.
Thanks a lot, Ingrid and Sebastien.
Thank you very much. Bye.